Good morning, everyone. Thank you for inviting me here to this awesome event to moderate this very interesting panel that I'm really excited to be part of. So I am Pallavi Madakasira. I'm the Director for Clean Energy here at the New Jersey Economic Development Authority. The NJEDA is the state's principal agency to drive economic development. And so all this means is creating jobs for everyone, as well as driving investments into the state. So in my role here at the EDA, I oversee a portfolio of products and projects that cut across a spectrum of technologies in clean energy and clean technology. So everything from energy storage to zero emission transportation, biofuels, certainly all aspects related to solar and your more traditional renewables. The EDA also has a very strong emphasis on offshore wind. Thanks to Governor Murphy's Energy Master Plan, which sort of lays out this bold, aggressive mission for the state, we, as the principal agency for economic development, essentially ensure that all our products and projects speak to the ultimate goal of getting New Jersey to a decarbonized future by 2050. The state has some incredible initiatives that are currently ongoing. So if you're interested, I would encourage you to go check out njeda.com. So for example, we are currently building the state's first purpose-built offshore wind port. When it's completed and built, we will have about 7.5 gigawatts of offshore wind across the shore on the shores of New Jersey within the next 4 years. Similarly, we've already initiated strong efforts to decarbonize our transportation sector through the launch of our New Jersey Zero Emission Incentive Program, or NJZIP, where we've already committed over $45 million of RGGI funds to convert diesel-based medium and heavy-duty vehicles into their zero-emission alternatives. With that, I do want to take a moment to, again, remind the audience that we encourage you to please type in your questions into the Q&A box throughout the panel discussion. We will take as many questions as we can in the time that's allocated to us. For this panel, I'm very happy and incredibly privileged to be sharing the stage with two awesome panelists who've spent over 20 years in the industry in clean energy and broader sector-related work as investors and as advisors, and continue to certainly play key roles in this sector. So without further ado, I do want to introduce Tom Erickson, who is the managing partner at Imperative Ventures. Tom has over 25 years of experience as board director, investor, and advisor. Previously, Tom co-founded First Green Partners, which is an energy and industrials investment firm backed by Warburg Pincus. Tom also serves on the NREL Investor Advisory Board and is a director at Monolith Materials, Trellis, and NLO Tech. So welcome, Tom.
Thank you, Pallavi. It's good to be here. Look forward to the discussion.
Absolutely. And our second panelist is Vishal Shah, who is the CEO and managing partner of Hydrogen Technology Ventures. Vishal has also spent over 20 years as an investor, advisor, and an operator. Previously, Vishal was a partner at Hudson Sustainability Investments. He founded and led the clean energy equity research practice for Lehman Brothers. He also led the ESG investing practice for Deutsche Bank well before ESG investing became mainstream. So welcome, Vishal.
Thank you, Pallavi, and good to be here. Thanks for the invitation.
Awesome. So we have about 35, 40 minutes. I certainly intend to use every minute of it. And I know I'm eager to get going, so we'll jump straight into it. Let's start at the big picture, right? So there's, I think, about 35 or $40 billion of investment that, depending on what source you look up online, that have gone into ESG and climate tech investments year to date alone in 2021. And I believe this is about 40% over the entire set of investments that went into 2020. Why do you think there is this? I mean, the why is probably the slightly easier part, but then how do you actually see some of this translating into impact, sort of driving impacts, and how is this different? What's different about 2021 versus 2020? If you can start at the top, and then we'll dive into the details. Tom, do you want to go first?
Sure. I think there's a tremendous amount of interest in the space, a desire to have impact, and a lot that we've learned from the late 2000s until now about the way to build companies that are economically viable. And once they are economically viable, they can have massive impact. So there were a lot of lessons learned. There's been a lot of innovation in centers of excellence at the national labs. There are a lot of incubators and accelerators. So we have just a lot of companies that are ready to get to the point of commercialization and scale. And as a result, we've got a lot of new late stage money coming into the market, and many of whom are looking for curated deal flow in which to invest. So Vishal, I'll let you kind of fill in some of the blanks there. Sure.
I would also add that I think what's different this time around is a realization that the opportunity set is much wider and larger compared to even a decade ago, right? So in the first wave of clean energy investing, we were looking at sectors that really needed a lot of incentives, and companies were not proven. What we have over the course of the last 2 decades is companies that have successfully proven the business models. We have companies that are nearing $1 trillion market cap, in one case above $1 trillion. And so what I think investors have realized that this sector has a lot of potential, even without strong policy support over time. And the next phase of the $1 trillion market cap companies, the leaders of the S&P 500 over the next 2 decades will be the clean energy companies, right? If you look back and see what happened, in 2000s, you had a lot of the traditional energy sector companies that were making the top 5 to 10 companies in the S&P 500. If you look at what's going on today, it's mostly all the tech companies. That's really driven by the investment that was made in the late 90s and the early 2000s. And I think, what's happening today is going to drive the next set of leaders over the next 2 decades, in our view.
Great. I want to drill down one other finer point, I guess, nuance to the set of investments. I mean, when I started 15 years ago in the sector, and the venture investors invested a ton of money and then they sort of moved away from it. The part of it seemed to be because the return on investments weren't necessarily like what you would normally see in the software or other tech sectors necessarily, because clean energy and clean tech has traditionally been, and to a large extent, to a large degree, continues to be manufacturing heavy focus. So when we're talking about this volumes of money that's clearly amplified, and there's a degree, there seems to be an increasing risk appetite, so to speak. But I'd be curious to get your take on what has fundamentally changed. Like, are investors such as yourselves, maybe it's you, maybe some other sets of investors, are you looking at clean energy differently from a risk profile standpoint or a return on investment than venture investors did 15 years ago?
I think that say 15 to 20 years ago, with CleanTech 1.0, there was a model for tech investing. There was a model for life science investing. There certainly was a model for energy investing, traditional oil and gas energy investing. And that model, the set of venture capitalists investing at that time were trying to figure out how best to invest in this emerging space. And many of them were not domain experts. They were trying to expand the existing mandate that they had and applied maybe a tech mandate where we would invest 18 months later, we'd have a value inflection point, we'd invest again, we'd bring in another set of investors, and we'd scale the business from there. But the reality is the technology, whether it was a technology risk or commercialization risk or market risk, the technology needed to be proven and then scaled. And I think there was a fundamental lack of understanding of the capital requirements, and at sometimes a false belief that maybe a license or a capital light business model was ultimately going to prove out. So we've got a lot smarter than we were 15 to 20 years ago, and we understand the value of unit economics, of plant economics, of where companies reside on the supply stack, so that the investments made in the space end up being very long duration, can be more capital intensive, but generate value for a long period of time. Innovations in some of these hard to abate industries, whether it's steel or cement, haven't happened in a long period of time, but those innovations are ready to be commercialized today with a better understanding of the framework to compete and or partner with the incumbents.
Yeah, I think I would also add that, look, to Tom's point, clearly the capital that's coming in has learned to become a little bit more patient with some of these sectors, which was not the case in the past.
Yes,
But I
yes.
think what has also happened is investors have understood, have learned the lessons from the mistakes that were made in the past to separate the technology risk from the infrastructure implementation risk, right? So I think there are a lot of companies that are getting funded by funds that are specifically dedicated to take that technology risk, and then many of these companies are actually getting a lot of funding from even the corporates that have opened their R&D budgets in a way that allowed them to invest in some of these early stage startups. And then when these companies are ready to commercialize their product, there is a separate set of capital, which is infrastructure like capital, I think, which is going to really help these companies get to that next stage of growth. And so I think those are some of the lessons that have been learned from the last two cycles that are that are very effective today in our view.
I think that's so true, Vishal. There are different funds, different return expectations, the set of investors that get committed to those funds at the early, middle, and later stage. And we saw it with one of the portfolio companies we have, where it was a small syndicate to begin with, scaled it with more of a private equity focus, and then brought in a set of commercial players to get the company to the point of commercialization or at scale. And now there are more than 40 counterparties ready to license, joint venture, build, own, operate in conjunction with the company. So yeah, I couldn't agree with you more.
So Tom, you mentioned in your opening remarks in particular that you see a lot of late stage money coming in. And between what you and Vishal just said, there's clearly various streams of funding now being made available for early, mid, maybe late stage. But are there particular areas where you're seeing shortages? Is it, if late stage is where there's a crowding in of money, are there other areas where there's a lack of, or maybe that we need to see more of?
I would argue yes. So first of all, I would say the space has a very collaborative ecosystem. We want these companies to be successful. If we turn down a deal or an opportunity, we're more than happy to share the rationale, work with a set of investors, help them identify a more appropriate source of capital. But I would say the gap really is between the incubator and accelerator and the late stage money. So the late stage wants no technology risk. They don't want scale up risk. They want to deploy capital to commercialize entities that have a very predictable, visible stream of revenue and earnings. And somebody needs to do the work in between that accelerator and startup phase of the equation to prove out the technology. And they're willing to take that risk. They'd like to have a low regret cost coming into that situation so that we can say our yield or efficiency, our product quality, or customer engagement did or did not make it. And at the point that we're ready to go forward, this final investment decision, we bring in more capital with slightly less risk and a lower return expectation. But yes, I would say the fundamental gap right now is between the accelerator, incubator, and that late stage capital. Would you agree, Vishal?
I completely agree. I would just add that, clearly things have improved. We are in
yes.
more capital flow coming into the sector, just broadly speaking, and some of that is going towards the earlier stage as well. But I do see there's an opportunity to do more there. I think there's definitely a gap. I would argue there's a lot more capital going into the later stage sectors and valuations that are not as, they're very rich, I would say. But there is definitely an opportunity to find the gems in the earlier stage and help those companies get to the, commercially ready stage.
Excellent. So I guess we should probably dive in a little bit about the flavors of technologies. I mean, solar was your most traditional, the technology that was a darling child for a lot of venture investors in CleanTech 1.0. But now, I guess I'll start with Vishal. Your firm itself says Hydrogen Tech Ventures. Hydrogen is everything right now. People are talking about fuel cell technologies, an alternative to fuel cell technologies. Can you and Tom maybe address where you're seeing the most attractive investment opportunities, but also flavors of technologies where you never thought would exist, but you're suddenly beginning to see innovation that's becoming interesting for venture investors?
Yeah, Tom, you want to start? I can go ahead and.
Well, you can start with the hydrogen, and I'll follow on from there.
Right. Yeah. Sure.
We're going to be in violent agreement. We know that, right?
Yeah. Our general view is that you need a good set of technologies to address climate change, and if you start with the net zero targets, you need both a clean molecule and a clean electron to work together to address the needs. And I think until now, a lot of the investments have happened in the clean electron space. So whether it's solar, storage, EVs, all those investments have continued to really have a significant impact on emissions. And we started, with the hardware sector. Business models followed, and then software companies followed after that. So you saw sort of three waves of investments in the, I would call it CleanTech 1.0, CleanTech 2.0. I think it's going to be the same here in the clean molecule space, which is where hydrogen would fit in. And, you're starting to see an emergence of hardware-centric business models, come out, startups that are focused on bringing some of these new lower-cost solutions to the market. A bit more capital intensive, not the traditional venture type models, but that's where the technology risk is is the greatest. I would very, well see a business model transition to companies that are offering some of these products as service, right? And that's really where the infrastructure companies are very keen to participate. And that's really where the software opportunity will emerge, not just within hydrogen, but a lot of other similar sectors. I mean, I saw a nuclear fusion company most recently got funded, So you're going to see more of those type of technologies getting funded in the next, call it 5 years or so, as we achieve or work towards our net zero targets.
Tom?
And just to add on, I in total agreement with you, Vishal. Maybe another way to think about these decarbonization technologies, we have the energy transition bucket, the emergence of renewables, energy storage, distributed energy, bio-derived energy. An area that we're spending a lot of time on right now is in hard-to-abate industries, and these may be process innovations that are less energy intensive, use alternative feedstocks. As I mentioned earlier, it could be in steel, chemicals, construction. Vishal mentioned, low carbon or net zero approaches to electrification, carbon capture and storage. And then I would say the last bucket of the four, energy transition, hard to abate, low carbon, the last of the four would be the circular economy. What we could do with metals, plastics, leftover battery materials to recycle, reuse, repurpose. So I like them. I like that model, though, the clean electron, clean molecule. That one's a good one.
Yeah,
I may co-opt it. I don't know. It's a good one, Vishal.
So I guess when we're so clearly more flavors, a lot more money. It's being the love is being spread across a spectrum of technology. So that's always exciting. In CleanTech 1.0 or 2.0, however we want to reference it, a lot of venture investors or investors in general invested in companies that had the coolest innovation, so breakthrough innovation, without paying too much heed to what happens in terms of commercializing the technology, so meaning supply chain related impacts. Today, the world looks very different. Just about everything that we talk about or touch or use in our daily lives pretty much rely on some sort of complex network of supply chain related issues or concerns. So how, as investors, are you investing in companies, but also setting them up to consider these multiple facets that they need to start factoring in as they think about sort of scaling up their technologies? And Tom, let's start with you.
Well, no, that's a huge issue. We have an investment in New Jersey cement company, and cement is hard to move around. Concrete is hard to move around. The cement business is an oligopoly, very close to the source of the raw material to produce the cement. Concrete tends to be very distributed, but if you're going to build a concrete platform, you've got to figure out where you're going to source the cement. The same in renewable chemicals, renewable materials, or bio-derived materials. Paying attention to the upstream source, the availability, the location is a huge issue. We have a battery company, for example, in the material space, and the question is, do we align adjacent to the electric vehicle manufacturer or adjacent to the battery cell manufacturer? But it's a huge consideration as you look to scale these businesses, and they're not just domestic businesses, they're worldwide businesses. They have to scale in India and China as well as the US.
Yeah, I think that, I would actually look at this as an opportunity because, what we see is there is an opportunity to create jobs in the local economies. And I think a lot of state and local governments are very supportive of bringing these type of companies into the economy. Second is, I think it's an opportunity to reduce emissions because if you are localizing a supply chain, I think you're really having a significant impact on the emissions. So I think that really helps quite a bit. And third, I think it's actually, it creates an opportunity to come up with business models and in many cases actually significantly improve the cost of delivered product, whether it's and I think, if you go back to the whole idea of electrons that cannot be transported, but molecules can be, and some of these molecules, the production costs of a molecule can be X, the transportation and storage costs can be 5X. And if you localize it, you can substantially improve it. And this is where I think distributed generation, just broadly speaking, is going to be a theme for investment over the next couple of decades, right? I think this is where sustainable investing, distributed, is going to be a significant factor, in all sectors, and hard to abate sectors more so, even in aviation, marine, all these areas. You're going to find production that is going to be more localized, and I do think that's going to be a significant investment theme, a very powerful investment theme in our view over the next decade.
Mm-hmm. Mm-hmm.
Excellent. So we're getting a stream of questions. So I'm going to try to pull in a couple here, and then we can get back to this. There's a question for Vishal specifically. Do you see a path to economic viability for hydrogen electrolysis? And do you view distributed hydrogen production that assumes nearly free renewable electricity being realistic?
I think so. I personally think that's exactly where I was going with this, right? I mean, the cost of producing gray hydrogen is $1. The cost of producing green hydrogen with today's renewable power is less than $3, maybe $3 to $4 if you were to be more conservative. But when you deliver that hydrogen, gray hydrogen, to the end customer, that customer is paying $10. There's no reason for the customer to pay $10 for that gray hydrogen. So we think that there's an opportunity to be very competitive with gray hydrogen without really significant improvements in technology today. I mean, and then there is a massive amount of investment going into new technologies, scale up. So with all of that, I think we're going to see hydrogen being where solar was, I think in much faster, I would say, the trajectory in the next 5 years. And I mean, the DOE has a target of 2030, but I think it's going to be much sooner than that we'll get to the $1 per kilogram level.
Mm-hmm.
Obviously, with my EDA hat on, I also have a question as it relates to just broader investments across climate tech. One of the challenges that has historically been the case, and unfortunately continues to be the case, is driving social impact through climate tech investments. I mean, and by that I mean, how do you translate the benefits of investments that venture funds and venture investors such as yourself are making to the small businesses that exist in some of these low and moderate income communities or overburdened communities? How do you sort of make the connect, or how are you trying to approach this issue? And I'll start with Tom.
Yes, no, we had an LP whose favorite line is "measure what you treasure." And what I would say, in working with the family offices that committed to the fund that we run now at Imperative Ventures, there's not just an ask, but a requirement, an ESG requirement, a diversity inclusion requirement with regard to the companies in which we invest and their compliance to these ESG standards. So I would say that the mandate or the requirement from the investors into the funds that we manage has changed dramatically relative to, I've been in the business now for 20 years, certainly within the last 5 years or even the last 2 years. About the money that's coming in and the types of companies in which we can invest. So we are asking and requiring that of the management teams that we back, the boards of directors that we build, and the companies that we scale for compliance, not only to ESG, but to the diversity inclusion issue at hand. So really, really important. And it can't happen quickly enough, but it will take time. So.
I would add that, I think not only from investors, you're also seeing companies that can actually promote diversity and inclusion are able to attract talent much more effectively. And in today's
This is true. Yeah. Yeah.
I think that's really the main driver for successful startups. So I think that management teams or startups are also realizing that this is something that will be extremely important for them, and that's going to help quite substantially in our view.
Exactly.
Excellent. Maybe just to pull us back again from a macro perspective, as you're looking across your own portfolios, or as you're seeking more interesting opportunities, what's your view on how the United States compares in terms of opportunities to invest versus, the rest of the world? And I don't know, Vishal, you want to go first?
Yeah, I would start by saying that all the recent policy measures have been a huge positive. I think, about a year ago or maybe 2 years ago, I think it was the complete opposite, where Europe obviously took the front and center stage in terms of some of the new areas that we were looking at. Even the last 2 decades, a lot of other countries overtook the US as it relates to, at least from a timing standpoint. Of course, US is a very large market, so the growth that we've seen here is a function of just the local demand. But I think what we see now this time around is a real opportunity for the US to take a lead. We are already seeing that in some of the recent policy initiatives, both from the infrastructure bill as well as the Build Back Better bill that has been discussed. I think those incentives are going to be a significant tailwind for new capital coming in, not only from within the United States, but also from international LP capital. I think there's a lot of investor capital that's coming into the US because of the positive policy support. Now, I think what's going to happen is other countries are going to follow. I don't think that, you're going to see this. This is what has happened even in the past, right? One country announces a set of incentives, others follow. And I think so this is going to be overall a very positive environment for emerging technologies in particular, because that's really what makes investors, take that final step of, investing in some of these riskier areas of technologies.
I think policy is huge, policy and a regulatory framework. I think the U.S. is blessed with an abundance of inexpensive energy. And as a result, when other multinational organizations are looking where to expand, they're expanding in the U.S. Because we have cheaper energy. We have an abundant source of exceptional talent, in an entrepreneurial community that, and an abundance of risk capital. So you've got talent, you've got inexpensive energy. We have technology development in the US. We have the ability to source technology outside of the US. The company that we built in Nebraska was sourced partially out of Norway, partially out of France, integrated at NASA Ames in California, and the first commercial plant is in Nebraska. But of the 40 opportunities to scale, 13 are in the US and the balance are outside of the United States. So I think it is a global initiative for sure. The sustainability impact space is global, but we do have some inherent advantage here in the United States relative to some of the other markets.
Okay. I'm going to continue to pull in some questions from the Q&A box here. So I think, Tom, you may have mentioned this. There's a company that had over $1 trillion in valuation.
Oh, no, that was Vishal.
That was
I
Vishal.
think he's talking about Tesla, right?
Yeah.
So I guess the question here is, do you think we are in a valuation bubble? And what are the implications if the bubble bursts?
Well, I think it's hard to say.
We're all three equity analysts, right, Pallavi? So this is the scary thing, right? We've all been here.
Well, I think, I think, look, I mean, there's definitely some excitement, amongst investors, and that's good for the sector overall. It does help a lot of companies that may not otherwise have access to capital. Clearly, there will be some investments that won't work out. I think that's typically the case of some of these cycles. I mean, I wouldn't be surprised. It's hard to say when this ends, but yeah, I think, you're going to see this, cycle repeat, and it's going to flush out some of the companies, which may also be good for the sector overall.
Mm-hmm. And Tom, do you want to add to that?
So yes, the first thing we learn as equity analysts is the world is a cyclical thing, and chemical companies are dominated by fear, not greed, and it's an interesting question because the SPAC wave certainly helped fund companies that were very long duration plays with billions of dollars of capital. So if you're on the early stage building these little companies and you're dealing with later stage companies that are going to build a plant or are looking to add to their technology portfolio, it's, we're in the business, everything is for sale every day as an investor. We're looking to commit to companies, to build companies, but the reality is we're generating value for those that gave us the money, those that gave us the mandate, the investors in our funds. So is there a valuation bubble? I think the SPAC wave has kind of come and it's backed off a little bit, and it certainly drove a bubble in the EV and battery space. But boy, what are those companies going to do now with the capital that they've been given? And the answer is they have to invest in technology in order to support the valuation that they were given and to build that portfolio of batteries and or vehicles to deliver. So I think it's probably more excessive at the later stage, or at the later stage of the market than it is at the early stage. I still think there's an abundance of opportunities and not enough capital to fund these businesses. So again, I think it's a very collaborative ecosystem. It's less competitive and cutthroat, say, relative to some of the other sectors, because there are fewer players and the opportunities are substantial. But at the end of the day, we need these companies to be successful, and they'll ultimately grow into the valuations, or as Vishal says, they're not going to make it. And we've seen that movie before for those that don't make it.
Yeah, look, I would also add that if you look at Tesla, right? I mean, Tesla was not profitable for a long period of time. Amazon, right. Another thing, right? And these companies have all created a lot of value for the shareholders, partly because the equity markets were open to those type of companies. And
they provided the capital, right? Yeah. They provided the capital to get through.
When the capital was needed the most. And I think if you look at what's happening today with some of these early stage companies, I think as investors, VCs are looking at these companies and are saying, well, I can invest in these businesses provided there is a path to exit. And I think the capital markets being open allow investors to take that risk, which is good for the sector overall. I also would say that, because of the positive momentum that we're seeing on a policy front globally, it is very likely that some of these valuations may remain high, as we've seen with some of the prior examples like Tesla and Amazon, as long as these companies are executing on a path, right? So it may actually work out well for some of those investors that have taken the early stage risk and invested in these companies. And many of these companies have taken the SPAC route and have actually enough of capital on their balance sheet. As long as they use their cash prudently, I think they'll actually do really well.
But don't you? It does put pressure on those earlier stage companies to either align with a strategic or align with a large source of capital to compete. So in some respects, some elements of the game in this space are, they're already taken care of. These businesses are very well funded. So the idea of building a large multi-billion-dollar battery factory is really a challenging one unless you have a very large balance sheet or some compelling technology. So it's a bit of a chess game, right? Trying to figure out where the players are. Mm-hmm.
I guess I'll piggyback off of your last comment. There's obviously, you referenced, we've talked about Tesla a little bit, and certainly I think between Vishal and yourself, Tom, you've talked a little bit about, somewhat difficult to fund or underfunded areas of opportunities like the steel or the cement industry, which are not as sexy, but clearly the impacts of carbon emissions are substantially higher. So just from a big picture standpoint, are you seeing, or are you beginning to see areas that are already getting overcrowded in terms of investments that particular flavors of technologies are getting, but maybe there's not as much love for others that need to have them? And I'll start with Tom.
Overcrowded. I would say certainly the EV battery space, there's been a lot of hype, a lot of enthusiasm, and a lot of capital committed. And that's not to say there aren't opportunities in cathodes or anodes or electrolytes or in solid state, but it's probably the area of greatest hype, certainly because people want to figure out how to invest in Tesla earlier, either through a SPAC into QuantumScape or Rivian or Solid Energy or Solid Power. Pick your name in that little battery ecosystem. But I'd say it's the area of greatest focus and perhaps overinvestment at this stage of the game. But I think hydrogen, we're still in very early games, but I'll let Vishal, he's certainly expert in that arena. But we are very, very early in hydrogen and other alternative forms of energy storage besides battery.
Mm-hmm.
Yeah, I think, Pallavi, I think this is true with all sectors. 5 years ago, maybe even 3 years ago, there were only a handful of publicly traded clean energy companies in the S&P or in the market, right? And today we have a significantly large number, and investors tend to gravitate towards a certain set of sectors. And EV has really received a lot of attention because of some headlines that we've seen, and it's easy to understand. We're seeing the success of Tesla, so clearly that is a space that seems to be overcrowded.
The halo.
Yeah, exactly.
That created the halo. Mm-hmm, mm-hmm.
Right. Yeah. So, but I do see, an opportunity for some of that capital to move into newer areas, whether it's hydrogen, whether it's some of the other, battery technologies, specifically, companies that are going to, have a much bigger impact. And so those type of areas are definitely going to find more capital flowing in over the next year.
I would say, yeah. So in the circular economy, battery recycling, sourcing of raw materials for batteries, or reusing old batteries. You would think this, cement, which is one of the largest producers of CO2, 6 to 8% of emissions worldwide. There's a lot of new investment coming into the space. It's not just cement, it's aggregates, it's admixtures, it's alternative cements, new production methodologies. So
what about in equipment? I mean, the one thing that I haven't heard anyone talk about is like innovation in equipment manufacturing as it relates to producing.
On process innovation, yeah, on process innovation for sure, whether it's reactor technology or alternative sources of energy for, using electricity instead of natural gas or oil, using natural gas instead of oil, using bio-derived gases instead of fossil fuels. So yeah, there are a lot of ways to put the pieces together. At the end of the day, while you can do it, do you necessarily want to do it? And that's really the economic framework that I think maybe in the early CleanTech 1.0 was not really taken into consideration. It was, we can do it, we have a regulatory mandate, let's do it. Now it's, okay, if we don't have a regulatory mandate, will it still survive? Right. Do we have the capital? Is the risk capital worth deploying?
Mm-hmm. So we have about 7 minutes. I'm just doing a quick time check. There's a couple of questions I want to try to squeeze in the time that's left. Great. So across a number of investment sectors, there's an increasing political element to cross-border investments in Chinese and US companies. So to what extent is this the case in clean tech investments? And I'll start with Vishal on that.
Yeah, I don't think we have seen a lot of cross-border investments in clean tech yet. That has not yet come out. I think you see a lot of opportunity here just within the US, and I think investors are not as focused on overseas investments yet. But I do see that happening in the course of the next couple of years.
Okay, and Tom, do you want to add to that?
Well, I guess I'm not certain I understand the question. If it's cross-border, if it's international money coming to the U.S. or U.S. money going internationally, or both. We do have CFIUS-related issues, right, from the U.S. government that precludes foreign investment in some of these key technologies in the U.S. But I think clean tech sustainable investing is really a global opportunity, a global problem, and we're partnering with every one of these, with companies in every one of these countries. So it's there is a political element, and it's actually a question where we need an epiphany every day to try and think, well, how are we going to navigate that set of issues, and how do we get to alignment? So I think we collectively need to have common goals relative to some of these objectives, and then figure out the right partners with whom we can work going forward. I think fundamentally that there are a lot of, at least in the hard to abate industries, there are incumbents that have the same set of problems that we have in the US. And how do we work collectively to make it happen? It's a tricky one. It's a good question, a tricky question, I think.
Yeah. I mean, obviously, we are here at the Princeton Engage event. We have a number of budding entrepreneurs, aspiring entrepreneurs, and those that have maybe founded their companies just recently. What advice would you have for these companies to either get in touch with you? How do they get you as their audience? What advice do you have for entrepreneurs that are just getting into climate tech or setting up their companies to scale? Start with Vishal.
Well, feel free to reach out. You have my information, so happy to have a conversation anytime you guys have any questions. Happy to meet in person. I'm based here in New Jersey, so feel free to reach out.
And Tom?
Yes, my email's on the website. Please just shoot me an email. I would say, relative to the development of the company or the startup, it's really understand what you're trying to accomplish, why you're trying to accomplish, how you're going to do it, and create a framework that defines what success is. Is it if it's a biotech platform, it's rate yield tighter. What creates an economic value for the invention that you have or the technology you want to deploy. I think impact is certainly a lens that we're all focused on as investors who are on the table here. And, we're excited about the space and I love working with entrepreneurs. So it's really trying to think about that business model and capital requirements and what we need to know and when we will know it to scale the business. So it's an exciting space for sure.
It is. And I'll ask one last question. I think we should be able to squeeze one in. Is as we wind down this panel, obviously this discussion can go on for hours on end. There's a lot of interesting topics that we didn't actually even get to. But as you look for investments, what particular aspects or features of the team or the technology or the pitch do you tend to gravitate toward that's important or higher in your priority? Maybe we'll wind down this panel discussion with that, and I'll start with you, Tom.
When we were equity analysts back in the day, we would recommend an investment opportunity, but we would always know the reasons it would fail, right? We always knew, well, this is the set of assumptions that I really believe in and stand behind, but this is how it would fail. And I think when working with entrepreneurs, it's that self-awareness and understanding the risk profile and what needs to be accomplished. So maybe a self-aware and a really critical thinker, and a basic understanding of the business model you're trying to pursue. That's really, really important for these businesses.
And Vishal?
I think I would add to that. So number one is going to be the team, right? The people itself, right? How passionate they are, whether they can really, and it's very important even for the earlier stage startups where they don't have a demonstrated track record. So I think it's all about the people. I think it's also going to be a function of the TAM, right? The available market that they're going after and how big of a risk they're willing to take for that and what the upside could be if they take the risk, because that was always the problem with CleanTech 1.0. The market opportunity was not that big. And now we have several $1 trillion of TAM available, right? So the pie has shifted quite large and it's become much larger now. So you could certainly pick a subset within that TAM, and I think those are the two main areas that I think we would be focused on as we look at new startups and new opportunities.
Excellent. I've just been given the time that we're nearly out of time. We got the hook. Yes, exactly. So I really appreciate both of your time and your input. This has been a really exciting panel. It's super interactive, and I love all the questions that were coming in. Unfortunately, we couldn't get to all of them, but hopefully you all in the audience have our email addresses. So please feel free to send your questions and you'll get responses. With that, I will thank the organizers for inviting all three of us here to the panel. And thank you.
Thank you.
Thank you all.
Thank you.
Bye-bye.